Good evening. Good evening. Good evening. Good morning. Testing.
Good evening, good
Yeah,
evening.
Hey, how's everybody? How's everybody?
Awesome, awesome. Yourself,
yeah,
good
we're
morning.
good. And you?
No, I'm well. I'm well. Thank you. Thank you. Thank you. Now let's get straight into it. I trust everybody had a good weekend. Let me just do this. Yeah. Yeah, let's get into it. We spoke about inflation last week, measures of inflation. Um, I trust everybody had a chance to go through that recording over the weekend. Let's get some questions in. Any clarity seeking questions or comments regarding what's going on in the market or something that they don't understand? Feel free. Feel free. Let's get those questions in.
Yeah. Can you hear me?
Loud and clear.
Okay. So I was actually going through the recordings of last week,
Yeah.
precisely the last two meetings we had, and
Yes.
you talked about the monitoring policy tools.
Yes.
You were so the next day when you were asking us, we mentioned interest rate, and then you were mentioning quantitative easing. But I remember that in the monitoring policy tools,
Yeah.
we had a discounted rate, the open market operation, then we had interest or reserve, and then
Yes.
the interest itself. Yeah,
Uh-huh.
so I was wondering where the quantitative easing then comes into play. That actually got me confused when I was
Yeah.
analyzing.
Yeah. You did not see QE there. No, that's a great
I did
question.
not say what?
Yeah, yeah. Quantitative easing was not mentioned. Am
Yes,
I right?
exactly. It wasn't there. It wasn't mentioned. Yeah.
Yeah. No, quantitative easing is another monetary policy tool, a relatively new monetary policy tool that has been used by central banks and quite aggressively so, especially in the past 4 years. Quantitative easing. We will talk about it. Definitely. We are going to talk about it. I was quite tempted, I must say, actually, to talk about it last week, but I don't think we had the energy to do so. So I figured, no, let's where it's going to come in exactly is when we go back into time. Remember, I said I want us to go back into time a bit, at least 2019, and see how the economy has evolved and how monetary policy has been adjusted accordingly, right? That's where QE will definitely be mentioned. It plays a very big role in actually the current inflation that we are in, I would say. So fantastic
Okay.
question, Mr. Bruno. Fantastic question. Yeah, no, keep them coming, keep them coming. What have you been trading? Where are the profits? Where are the losses? What's frustrating you? Or what doesn't make sense? Let's tackle them. Any particular chart, maybe, or maybe some news that you've seen. You want to know how they affect the markets.
Yeah. Another thing I was trying to monitor, in the last meeting, we were also talking about using the news before the NFP, that is the ADP, the ISM data, to like predict what's
Yes.
going to happen for the NFP of
Oh,
Friday.
mm-hmm.
Yes. So
And
I was
this is the
trying to
week.
follow that and, try to draw
Mm.
my own inference, but, I don't, the full data is not
Yeah,
hard, though.
yeah.
We'll have ADP tomorrow. Then
And,
the unemployment
and
claims next month, they're about ahead. So,
yes. No, I love the questions. Love, love,
yeah,
love
so
the
today,
questions.
yeah.
It's a fantastic question because we do have that data that you're talking about this week leading up to NFP. Is NFP this Friday? Yes, NFP is this Friday. So I think it definitely would be fitting to start talking about that data because today we had the first round of that data come out. It's extremely important. It will help us to gauge the sentiment and where the market really is going, leading or ahead of NFP. It's not always, like I said, it's not a crystal ball, but it's merely a prediction, and it's data that I must say is usually on point. But we can be surprised sometimes just looking at the data. You know, you may think or anticipate a particular set of numbers for NFP, and then it comes out completely different. But I would say 8 or 9 out of 10 times we tend to get it right, right? We tend to get it right. So we
Yeah,
definitely
sure.
have to look into that data this week. We definitely have to look at it. I think we had JOLTS jobs opening. Yeah, we had JOLTS jobs opening and manufacturing ISM manufacturing data today. So yeah, yesterday I wasn't on the charts. I actually just only got back today. I was just on a little travel, but full. So I'm also playing catch up, if I can put it that way. I'm also playing catch up, but I do have 2 trades that are currently running, which is, in fact, it's 3 trades. We'll look at them near the end. I've got Nasdaq. I've got a sell on Nasdaq. That trade was open on the 27th, so that was last week. And also on the same day, I have GBP USD sell. And my recent one, which was open a few minutes ago, was USD CAD as well. So we'll look into those and the reason why I have those trades open. Yeah. So let's say, what screen am I showing here? Let me see. Okay, so we are on the economic calendar, but let's talk about what we spoke about last week: inflation, and interest rates, right? So we had those measures of inflation: CPI, Consumer Price Index, PCE, Personal Consumption Expenditure. What else? PPI, and
Yeah.
we did, yeah, PPI, and we also included labor there. We also included labor data because labor can contribute to inflation. Now, one economic module that would, make reference to labor and inflation is the Phillips curve. Uh, but like all economic models, they are not bulletproof. They do have inconsistencies, but we still make reference to the Phillips curve till today, right, as a economic model. So it is something that I can share as well with you. Now on inflation, or rather, let's say, yeah, let's talk about that inflation. So we said, what is the target? What is the target on inflation for most economies?
2%.
Give me that figure again.
2%.
2%. Yes, it's 2%, right? So the Fed, Bank of Japan, ECB, the European Central Bank. Who else can we mention? The uh, RBA, the Republic Bank of Australia, or rather, not the Republic, sorry, the Reserve Bank of uh, Australia. Who else? Who else? So all these major economies, right? They tend to go for the 2% target. Now, feel free, don't take my word for it, of course. Let's, for example, go to ECB. I want you to show you just the first thing that you're going to see on the website. Let's go to the homepage. Does anybody know who this lady is? Christine Lagarde, right? So she's the federal chair, or in this instance, they will say the president of the European Central Bank. She's been at the helm for a little while. Yeah, she's been at the helm for a little while. Then we've got other guys here who make up the part of the board. But on the homepage, where's the homepage? Yeah, so on the homepage here, you're going to see.
I've never heard of her. I'm just seeing her now for the first time.
I beg your pardon?
I said I must confess, I've never heard of her or seen her. This is the
Oh
first
yeah.
time.
No, she's been
All my has
around.
been on power.
No, she's been around. She's been around. And if there's anyone actually I respect out of all the heads of these central banks is this lady because she's got the most difficult, I would say, portfolio because um the ECB overlooks not just only one country, it's multiple countries that are using
Yeah,
the euro. So there's just too many moving parts, I must say. But she's done an exceptionally good job at regulating these economies because it's quite broad. It's not just one country. So big ups to her, I must say. So here you're gonna see that I want to see where it's quite plain where they mention their interest at what you call this inflation target. We're still on the home page. Let's see if I can find it easy. The last time it was very easy to find. What is this? No. Am I on the home page? Let me just make sure. I think I am. Reviews, ECB publications. Okay, they will show you the exchange rate. Just do this. Okay. Where is more on inflation? Okay, I think that's why I had to click on inflation and consumer prices, right? Why 2%? Our main objective is to keep prices stable. To achieve this, we aim for 2% inflation over the medium term. Our reference for measuring inflation is the Harmonized Index of Consumer Prices, the HICP, right? The HICP is compiled by Eurostat, the Statistical Office for the European Union, and the National Statistical Institutes of EU member states. The same methodology is used across all countries. So they pretty much tell you how they would measure it. So you know this is what you look out for, right? Inflation is a measure of how prices change over time. To calculate it, statistical institutes regularly collect prices for a basket of goods and services representing the consumption of all private people in the country. These national values are then compiled into an inflation rate for the euro area. Prices are collected from different places like stores, restaurants, online shops to get a broad overview of how prices evolve for different goods and services. So this is basically where the inflation rate is currently sitting at 1.8. So, I mean, if you look at back in 2020, where it peaked, they got to double digits, 10.6, last seen basically in a very long time, right? We can go further back into time, how we a bit more data, right? So double digits, this is a problem. This is not the type of inflation that you would want at this particular rate anyway. This happened in a very short period of time. So this definitely would bring about the economy quite happy where they are. They are within the twos now, 1.8. Remember I said, mid or let's say, yeah, mid ones, low twos is most or for most is that's what is considered comfortable. So it's a range, right? So we can see that is that 2%. You go to the Bank of Japan, you're going to find the same thing, right? Now, most central banks, let me go to the Federal Reserve side. Most central banks, they have mainly two things on their mandate. Mainly two things. So one already is inflation. Let me just write it down here. Inflation is one mandate they've been tasked with. What is the second one? The second and last one.
Okay.
Say that again.
Interest rate.
Interest rates. Well, not quite. They would use interest rates to, I guess, manipulate the inflation, right? But so that's a monetary policy tool. I want the objective that so they would use a monetary policy tool such as interest rate to reach this objective, which is inflation 2% target. What is the other objective? What is the other mandate they've been tasked with? So they need to manage prices, which is basically inflation. What is the other thing? Give me a sec. Give me a sec. Think about it. I'm just running across. I'll be with you just now.
Nothing else is coming to my head right now. Is it GDP? I don't think so. You there?
Are you talking to us, sir?
Hi, Lebo.
Hello, can you hear me? Hello?
He just slipped out. He said he's coming in a moment.
Okay, I'm back. I'm back. Does anybody have the answer? What is the other objective that they've been tasked with? Audible, can you hear me? Testing 1 2 1 2.
We need to keep the economy working like steady.
Did you say a stable economy?
Yeah, stable economy.
Yeah, it's quite broad, like but I need more. One more try, right? So because inflation.
Lebo.
Mm,
Hello.
yes.
Yes, I think from my end, at this point, I need to know which countries use the euro. I think if I can get that background, it will help me.
Remember, it was a task, or rather, should I say, an assignment that I actually gave out very early on, and nobody did it. You remember? You're not watching this.
I don't remember. I've forgotten.
I remember very well.
You know, adult education.
Yeah. I won't make it that easy for you, right? Because if you
But I can try, yeah.
Yeah.
I can try because I think it has been a question that I've been having also because when you're analyzing these news and I think if you don't know the country, you and all the Euro pairs, it becomes also a bit vague to analyze them.
I fully agree. I fully agree with that. What I did mention very early on when I gave you the assignment, I said we were looking at the economic calendar. I said Germany, and I said I'll mention just the big ones at that time. And I said go find the other ones. I said Germany, and I said France. Right? Germany, France, because those are big. We know they've got a sizable manufacturing sector. We know Germany, what they produce. We consume a lot of German products. They've given us BMW, Mercedes, VW. It goes on, right? France, we've got Renault, we've got Citroen. What other cars? We've got there's a lot of things that they also do. So I mentioned only those two, and I'll mention one more: Spain, Portugal. Right? Very easy to find. Last week at the end, I said the best way to learn and not forget is through research. So I will always just point you in the right direction so that you can go and dig up a little bit more, right? So we've got quite a couple of countries. One that also comes to mind, Finland. I hope I'm not wrong. Finland. Yeah, Finland, if I'm not wrong. Yeah. So there's quite a couple of countries that use.
I think there's also is it Spain?
Spain, indeed. Spain, indeed. Spain is definitely there. 100%. All right. So you're gonna find them. I'll leave it as that.
Yes.
I would love,
Yes.
I would love to get that.
Yeah. Yeah. So this Federal Reserve Bank, where is it situated? Which country?
Okay. I see maybe where you might be a little lost. Okay. So the ECB, the European, let me go here, this website here, this bank here, the European Central Bank, they oversee the euro and all the countries that, of course, use the euro area, or some will say the eurozone. Okay, those countries that we've just mentioned now: Spain, Italy, France, Germany, Finland, right? They form part of the eurozone or the euro area. They use the euro, and this is their central bank, European Central Bank. Now, where is the European Central Bank situated? I do stand corrected on this one, but I believe it is France. Could be wrong. Hey, don't take my word for it. Could be France. Right? Could be like where their physical address would be. I suspect it could be France. I think I can check it for you. Right? I can check it for you. And as for the US, well, they're definitely situated in the US. I'm not too sure where the big boy sits, right? I'm not too sure where their address is. But remember, we said the Federal Reserve, of course, oversees the dollar, right? But then they've got 12 central banks, right? Because they've got 12 states. Remember? 12 states. Let me just do this. Oh, thank you. They're in Germany. Okay. So the ECB, they're in Frankfurt, Germany. Thank you. Thank you for that one. Where is the Fed? The Fed. So the Fed oversees just the dollar, no other currency, Mr. Brian, just the dollar. They are basically, of course, in the US. I think somebody can also check again for us exactly where their headquarters would be. I've never really, maybe I have seen, or I do know, maybe I forgot. But basically, they've got 12 central banks. 12 central banks. Right? 12 central banks. Any other question? Any other question? We are still on the objective. And this objective is very similar, if not the same, across all these central banks. It's what we call a dual mandate, right? Number one being price stability, in other words, inflation. And I might as well just give you the other one for the sake of time. The other one is maximum employment. Maximum employment. So it's maximum employment and price stability. Those are the only two concerns. Nothing else. Maximum employment, price stability. So as a central bank, they need to use their monetary policy effectively to allow a conducive environment for these two things to happen, which is price stability and maximum employment. Right? So far we've spoken about interest rates as a monetary policy, right? We have spoken about how they use it to affect the economy for both the employment and the price stability, in other words, inflation. You remember? I think I also shared, hopefully, and those PDFs with you. Did I? Or did I not? Library, let's see. Interest rates as a monetary policy, yes. I did share that with you. So, interest rates as a monetary policy, We know that when you hike, we said, let's just go over it quickly because some did say last week, Thursday, that, hey, this is just confusing. So interest rates, let me try to get this pen. Interest rates, when you hike interest rates, we said what happens to the money supply? Does it go up and down, up or down? The money supply, what happens to the money supply?
Down.
Money supply, when you hike interest
Go
rate,
down.
goes down. What happens to the value of money?
Goes up.
Goes up. So in other words, if these are interest rates of the US being hiked, you will see on the chart the dollar doing this against other currencies. Does that make sense? Anybody?
Yeah.
You let me know, guys, if you're complete. If you're completely lost, do say so that we know.
Yeah, I think on interest rates versus the dollar, I'm okay. On money supply, why are you saying if interest rate increases, the money supply will reduce?
Exactly. Okay. So remember, when you have high interest rates, it discourages loaning or rather borrowing money because the cost of borrowing goes up. The cost of borrowing money goes up. Hey, what am I writing here? Hey, it feels like a mandate today. But you get it. Double R, ne? Borrowing. Yeah. The cost of borrowing goes up. In other words, so a simple life example. If you go to the bank and you want to, get access to a loan or credit, and they say, listen, give us your what you call this, your bank statement. If you're employed as well, let's get your pay, your pay slips, etc. And they say, okay, we can't give you the money, right? We've looked at your expenses and what you earn. We can't give you the money. We've tried to play around with what you would have been liable to pay us, but we can't get that interest rate any lower, and you still can't afford, right? We are sitting on 15%, right? That's what we want back from you if we were to give you that loan. But according to the system, you don't qualify, right? And remember, we said the interest rate that is set by the central bank affects the rate that is also charged by commercial banks, which is where we go. Those are the people that those are the banks that we interact with on a daily basis, right? We don't interact with the central bank, right? So now let's say a couple of months later, 3 months later, the central bank decides to lower the interest rates, which then of course affects the rate that is charged by commercial banks, the bank that you interact with on a daily basis. So you go back, nothing has changed. You're still earning the same. Your liabilities, your monthly liabilities are still the same. You go back and apply for the same loan. This time around, there's a high probability that you will be approved for that loan. Why? Because interest rates are much lower. The cost of borrowing is much cheaper. Are you following?
Yes, we are.
Yes.
So there are a lot of people who would be in that same situation where because the cost of borrowing is much higher, they may not be able to afford, or they may actually not even qualify for that credit. So remember, I think, let me go one step. How money is brought into existence, into the economy, is through credit. right? It is through credit. That is the only way that the money supply can be increased within an economy. It is through credit, right? So when the cost of borrowing goes down, the money supply then will increase because the cost of borrowing is cheaper. So more people like yourself and I will get access to cheap money, if I can put it that way. So I will go and say, oh, or even if I didn't even need it, I might be enticed because, oh, shucks, okay, I was just there at the bank. I wanted to do basic things that I do on a monthly basis. And then I was told that, hey, listen, don't you want a credit card? Do you actually qualify for a credit card? Listen, this will be, I don't know, 50,000 per month, whatever. That's the credit that we'll start you with. And then, it's enticing. Maybe I go sleep on it, or maybe I don't. Maybe I say, okay, sign me up right there and there. Right? So now, by me taking that credit, I've just expanded the money supply in the economy. Because now they can digitally print it, because now in this day and age, honestly, we don't, well, in mostly developed economies, and I would say also in South Africa, that the use of physical money is slowly dying out, right? So I'm saying printing, but you get the point, right? I've got access to that money. Now it's going to be in the actual economy. I'm going to be spending it within the economy. I'm not taking the money out of the country. No, it's within the economy. So I'm going to be going to those restaurants, maybe the hotels, wherever, clothing stores, grocery stores. That money is now in circulation. You follow? I've just put money into the economy, that 50,000. But if I don't get access to that money, and many more people don't, then the money supply decreases over time. So that's how interest rates affect money supply and affect the broader economy, if I can put it that way. Is this bringing about any clarity?
Yes, Lebo, thank you.
Thank you, sir.
Although I have another version, because we are saying if we increase interest rates, we are saying also it attracts investments into the country. Won't that increase money supply?
Yeah, to a certain degree. But broadly speaking, right, when you definitely hike your interest rates, you are definitely squeezing that money supply, right? High interest rates, you remember I said last week, there are, one or two countries with a very unique situation, and one of them is Turkey, right? And I think it was Bruno who also mentioned Nigeria's, interest rate sitting at I think 23 or something percent, but that doesn't necessarily bring about foreign direct investment into the country, right? So you can hike it as much as you want. All you're doing is you're squeezing, you're siphoning that money out of the economy, right? For the day-to-day people. But that doesn't necessarily mean big money is coming into the economy. That doesn't necessarily mean it's attractive to me as an investor, because that's not the only thing I'm looking at as an investor. The economy or investing is much more complex than that, right? We are looking at political stability. We're looking at so many other things as well before we direct money into a particular economy. It's working perfectly last time I checked in for Turkey, they've got a reasonably high interest rate, right? So yeah, their banking sector is very solid. Their corruption index is very low. Money doesn't just go disappearing, things like that. Political instability. I guess, go on and on, but I'm hoping you're getting the point, right? I don't want you to be too focused on the foreign direct investment as a result of high interest rates. It's not always going to work out, right? It's not always going to work out. But for your national economy as a central bank, when they hike those interest rates, it's not their first focus is that it's their national objective, right? They're looking at this particular economy with all its moving parts, which is the civilians, the labor force. How does it affect this, right? How does it affect the labor force within the border? How does it affect the economy within the border, right? And not quite out there, right? So I would say high interest rates, yes, would I would say, entice or be very attractive to foreigners, right? However, it's a byproduct, if I can put it that way. It's a side effect. It's not really their intention as a central bank, right? It's not. It's not their main objective, right? Their main objective is to maintain price stability within the border, right? And maximum employment within the border. Alrighty. So when you hike interest rate one more time, hike interest rates, you are basically lowering the money supply, and then the value of the currency goes up. Nice and clear?
Yeah.
Okay. Alrighty. Wait, where am I? Hold on, I'm on the wrong page here. I'm on the wrong page. Hey man, I forgot what I was going to say. Yeah, so all of yeah, no, it's gone. My point has escaped me. All right. I will freestyle it. But as I move on, so remember, yes, you can have high interest rates, which of course will be attractive for others, for Arab, for foreigners, or not even just. And when I say foreigners, I'm broadly speaking about foreign governments or individuals or companies, right? So the US will always be the number one preferred currency, as a currency that is very stable, as a currency that is a what's the term that we use? It's a shucks, I forgot it.
Still haven't.
I beg your pardon?
Still haven't, no, that.
Yes, it's a safe haven. That's another point. And the currency is used. It's what's the term for that? It's used for international trade. It's what's the term for it? It's used for international trade. I'll find the term. It just escapes me. Right? It's used for international trade. Most international deals or trade are quoted in dollars. Most commodities are quoted in dollars. So it's definitely a currency that we would look at first, followed by, of course, others such as the Japanese yen and the Swiss franc. I would say maybe put the Swiss franc second, then the Japanese yen. Yeah, simply based on their interest rates, right? And just how sound those economies have been over long periods of time, right? So, yeah, let's move on. So we said interest rates, I think we understand how they would affect the economy, right? So in terms of households, like we said, if we have high interest rates, it discourages us from lending or getting access to credit. But if we don't get access to credit, what it also does, or what it's meant to do, is to encourage savings, if I can put it that way, savings, right? It's meant that we don't borrow money. So the economic activity is meant to slow down, right? Sorry guys, somebody's knocking. One more time, I'll be back. Okay, I'm back. Sorry about that, guys. Yeah, right. So when you, of course, have high interest rates, the whole point is to slow down the economy, right? And if you have lower interest rates, you're trying to, I would guess, increase the pace of the economy. And that goes for households and businesses. Of course, if households don't have money, businesses won't thrive. So all this is interlinked. All this is interlinked. So what I want us to look at is, I guess, let's go back into time on this one. So we are on the Federal Open Market Committee. This is their meetings, meeting calendar statements and minutes. You're going to find them here. The current ones, as you can see, were in 2024, January. The last time they met, it wasn't so long ago. It was on the 17th and 18th. The next meeting is going to be on the 6th and 7th of November. Let us go back into time. What year is this? 2021, 2019. Yeah, I would say 2019 is okay. Let's look at the start of 2019. Would 2019 be okay? Yeah, 2019. Let's look at that. Let's look at the statement, because it's going to tell us what the interest rate was, if I remember well, and the state of the economy broadly, right? Information received since the FOMC met in December, which was, of course, December 2018, indicates that the labor market has continued to strengthen and that the economic activity has been rising at a solid rate. Job gains have been strong on average in recent months, and the unemployment rate has remained low. So they're not giving us the percentage in terms of what the unemployment rate was, but we can go back in time and check it out. Household spending has continued to grow strongly, while growth of business fixed investments has moderated from its rapid pace earlier last year, right? That has moderated from its rapid pace earlier last year. So I think maybe you're asking, what is this business fixed investment? What do you think it could be? Maybe let's not go too deep without explaining some of these things. Does anybody have an idea what could be this business fixed investment? Any idea? No idea. Okay, I'll mention maybe, I don't know, one or two. They're talking about machinery, right? Things that they would use, right? Machinery. They're talking about expanding those businesses. We're talking about real estate. They're not building or buying or expanding, opening more branches, right? Those are Those are just some of the few examples I could mention as fixed investments by business. Is that clear?
Yes, clear.
Okay. On a 12-month basis, both overall inflation and inflation for items other than food and energy remain near 2%. So let's read it one more time. On a 12-month basis, both overall inflation and inflation for items other than food and energy remain near 2%. Can sound confusing, but it's quite simple. So when they say overall inflation, they're talking about headline inflation, the normal CPI. This one here, inflation for items other than food and energy, they're talking about core inflation. You follow? Core inflation. Although market-based measures of inflation compensation have moved lower in recent months, survey-based measures of longer-term inflation expectations are little changed. This is rather very important. If you remember in last week's session, I did say we need to talk about this here. Inflation expectations. They play a big role in where inflation will actually end up. Consistent with the statutory mandate, the committee seeks to foster maximum employment and price stability. See, there's no statement that they will make without mentioning their mandate. Maximum employment and price stability. In support of these goals, the committee decided to maintain the target range. What they're talking about there is interest rate, right? For the federal funds rate, interest rates, right? At the rate of 2.25% to 2.5%. The committee continues to view sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcomes. In light of the global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate to support these outcomes. So it sounds a bit too much, but it's actually not, right? Where is it? Inflation pressures. What would contribute to inflation pressures? Now we know what macroeconomic indicators to use to measure inflation, right? We know what to use to measure, but we said now the question is, what could affect inflation? What could affect inflation? Interest rates can affect inflation. Sure. That's a given. We've spoken about that. What other factors could affect inflation or give about inflation pressure? Think about what's going on in the world currently. Over 2,000, I think, is it Lebanon? What's the country? Over 2,000 people are dead in a very short space of time. I think in just 2 weeks or a week, I think, 2,000 people dead. They're bombing people like flies. We're talking about geopolitical events here. Geopolitical events can affect a country's inflation. 9/11, who remembers the 9/11 incident in the US? That can bring about inflation or economic instability, right? Now, why would what's going on in the Middle East affect inflation in the US? How could it affect it? Somebody paint a picture for me. How could that affect? I beg your pardon?
Oil prices going
all
up.
prices, all prices.
Mm-hmm.
We are all interlinked one way or the other. We all need oil. So all prices, because all prices will go up because the production and supply can be interrupted or disrupted in the Middle East. Therefore, prices may go up. If the prices of oil goes up, everything else pretty much goes up because, well, oil is responsible for, those shipping of goods and those goods all over the world. That ship must dock somewhere, move from point A to point B, dock. Trucks must come and load, right? Those trucks use diesel. Diesel is a derivative of oil. Okay, so if oil prices are going up, diesel prices go up. Those trucks delivering, those fees will go up, right? And whatever is transporting, once it gets to where you are going to go and buy those goods, whoever bought them will have to redirect that increase to you, the consumer. Are you following?
Yes, Babs.
Are we tired? Right? So those can be inflation pressures that the central bank is talking about. Right? Alrighty. In determining the timing and size of future adjustments to the target range for the federal funds rate, interest rates, in other words, the committee will assess realized and expected economic conditions relative to its maximum employment objectives and symmetric 2% inflation objectives. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures, and inflation expectations, and readings on financial and international developments. So the central bank pretty much tells you what they're looking at to determine their monetary policy. Any question on this one? They tell you, they say, they'll take into account a wide range of information, including measures of labor market conditions. What would they be looking at? How would they gauge those labor market conditions? They're talking about unemployment rate. They're talking about those wages. Unemployment rate, wages, jobs created. They're talking about those ADP figures, right? ADP employment data, JOLT jobs opening data, etc. The weekly unemployment claims, they're looking at that data. That's how they can measure those labor market conditions. Is that clear? It's all scheduled. It's all on the economic calendar, such as your Forex Factory, your Trading Economics, or even your broker's economic calendar. It's there. Indicators of inflation pressures. We know CPI, PPI, what else? PCE. Have I forgotten? Yeah, I think that's it. And inflation expectations. Those readings, I'll show you where we can get them. You won't find them on Forex Factory. Any question? So let's see what the interest rate was let's say 2.5% at that time. That's what the interest rate was at the start of 2019. Did we have COVID at the start of 2019?
At the end.
At the end, exactly. So let's go look at what the inflation was out of the US, right? And they're sitting on about 2.5. Let us see what their inflation rate was at that time. United States inflation rate. Let's go 5 years. No, we need to go back a little more. That's September. Let's look at 10 years then. 2019, January, February, 1.6. Right? 1.6. Is it 1.6? Yeah, 1.6. See that? And their interest rate was 2.5%. I would say fairly okay. It was within the range. I would say it was within the range. Yeah, let's look at the last couple of months leading up to that year. 2018, October 2.5, November 2.2, December 1.9. And you must remember one thing. October, November, December tends to be the busiest last quarter, right? It's the last quarter of the year. The demand for goods and services tends to go up, right? The economic wheel tends to turn a little faster, if I can put it that way. But I'm seeing something very interesting here, because from October 2018 to December, it's going down. So is that, let me try and get to it again. October, 2.5, November, 2.2, December, 1.9. That doesn't look like the best time, right? If anything, it should have nudged up a little during that time, but it shows that there was a slowdown, economic slowdown. Are you following? There was an economic slowdown. Fine, then we see January, it goes even lower. February, even lower. So the economy seems to have been taking a slow day. I want us to go back to that website, what it was at the start of the year. COVID was at the end, right? At the end of the year. So let's choose a random one. Let's say, I don't know, June for the same year, and see if there was any adjustment made to that interest rate, right? Let's see. They kept it the same. Yeah, it's pretty much what they've been saying. I can just tell basically, right? But I'll read it. Information received since the FOMC met in May indicates that the labor market remains strong and economic activity is rising at a moderate rate. Job gains have been solid on average in recent months, and the unemployment rate has remained low. Although growth of household spending appears to have picked up from earlier in the year, indicators of business fixed investment have been soft. So the wording has changed, and that's something that you need to be take or pay attention to, if I can put it that way, right? So they've moved from, what did they say the last time? Because that's not the wording that they used. Now they say soft, but that's not the word they used. They said there was something to the effect of it slowing down, and now seems to be soft, right? So it's basically telling the central bank that businesses are not longer reinvesting. The economic wheel seems to be slowing down, right? Even though things on the surface remain solid, but just by looking at the business sector, they're not really, investing as much as they were perhaps in the past. On a 12-month basis, overall inflation and inflation for items other than food and energy are running below 2%. The wording too has changed. Those are the things that you need to pay attention to when these reports come out month on month, because it gives you a very good idea of what the central bank will likely do in the near future. They've changed their wording here. And if you maybe are lost at what I'm saying, I want you to go and read that report, okay? The January one that we've read, and come back to this one again and read it. You'll see that the wording has changed. So now they have emphasizing that definitely it is below 2%. Market-based measures of inflation compensation have declined. Survey-based measures of longer-term inflation expectations are little changed. Consistent with the statutory mandate, the committee seeks to foster maximum employment and price stability. In support of these goals, the committee decided to maintain the target range for the federal funds rate to basically 2.25% and 2.5%. So they still decided to, keep those interest rates the same. Now, you must understand also another point that central banks are not proactive, they are reactive, right? They don't want to cause us or find themselves in a situation where they've put themselves into a corner or they've essentially, collapsed the markets. It became a self-fulfilling prophecy, if I can put it that way, right? So they rely on a lot of data. They don't say, it seems like this is where it might be. I don't know how I can put it for you, but I get this question quite a lot where they say, what I'm asked that if is the central bank, forward looking. Yeah, to a certain degree they're forward looking, but they don't like to get ahead of themselves, if I can put it that way, right? They wait always to the very last minute before they actually make a decision, right? They really want to convince themselves that they've got enough data, right? So if really they were proactive, maybe a lot of recessions could have been avoided, but that's not quite how they work, if I can put it that way. The committee continues to view sustained expansion of economic activity, strong labor market conditions, and inflation near committee's symmetric 2% objective as the most likely outcomes. But uncertainties about the outlook have increased. See, that wasn't there in that statement that we read. But uncertainties about the outlook have increased in light of these uncertainties and muted inflation pressures. The committee will closely monitor the implications of incoming information for the economic outlook and will act appropriate to sustain expansion with a strong labor market and inflation near is 2%. I don't know if I'm losing you, but I hope not. It's because this is very, very important. But you need to get used to this central banking jargon, this central banking language, because once you familiarize yourself with it and you get comfortable with it, it's very easy to read actually, and you get a clear idea of what's going on with a particular economy. What I've just read to you here, what comparing it to January's report, what are you getting? What sense of, tell me the state of the economy from January to this one, I think is June. Yeah, this is June. What are they telling you about the economy? What are they telling you about inflation? Is this too deep? Shall we sleep on it?
It looks like too much information for me.
I don't mean to laugh, is it, Mr. Brian? Yeah. Hey. Okay. Glorious FX. My sister, you've been quiet. Or maybe you were not there for a couple of days. Glorious. Are you there? Who else do I have? Sile. Bito. Mokomoti. Pastor. I've got one.
Yes, sir.
I've got. Is it new? Is it too new? Am I moving too fast? Too slow?
Actually, for me, I think this is very key. I'm attentively listening to you. I have a number of questions concerning this information.
Yeah.
Like, for example, I want to know how long, like, say, I think you will give us more information. I'm waiting on that in terms of, like, after it is released, after maybe we get the information, I want to know how is it going to affect the dollar because it's Fed, they just met, and for how long? Yes.
Yes. I think somebody also asked last week, how long does the market engage this data or the effect, right? That is always going to be a complex one. It's going to be extremely hard to say it will take this long, right? The data can be engaged, and we can see the market really pricing in this this announcement, or this report rather. It could be something that takes a couple of hours, but usually, what I've noticed anyway, it can take a couple of days, sometimes even weeks, when it comes to central banking decisions or policies or reports. It just depends on the significance, I guess, of that report, right? That's if anything, right? Sometimes it's cut and paste. Well, it seems, it really appears that way. Sometimes really they play it safe, these central bankers. They tell us the same thing over and over without really changing much, right? Yeah. And I think the biggest impact will come out from actually a monetary policy change. Right now, currently, from January to the June one, there hasn't been a monetary policy change. Remember, so far, what we have explained at length is interest rates. Those interest rates, if you looked at them from January, is the same as June. They haven't changed. But they have raised concerns. Are we able to see the change in tone or wording from the report, from the January's report to June's one? There's definitely a difference. Maybe let's leave it here. I think I want you to go and read that report, right? January, and compare it just with this one, June. There's definitely a change, right? There is definitely a change. So I want you to just read it one more time. But essentially what they're saying is that the economy is slowing down. The economy is slowing down. Right? That's what they're saying. The economy is slowing down. The economy is slowing down. That is what they're saying. But I want you to go and read it for yourself. January's report, 2019. And then come and read the June one, 2019. The COVID thing hasn't happened yet. Hasn't. That only happens at the end of the year, but actually it only hits the US and let's say the entire world only at the start of 2020. Because we go through the end of the year quite okay, right? I'm talking about economic stability of South Africa, everybody else, except of course, China was already in a situation. I think only the last few days in December did they only go into a lockdown. But already people all over the world had been traveling China and going back home to various countries. And that's where the movie really starts. Right? So, okay, let's try and see what the report looks like for December then. By this time, maybe they made mention of what's going on in China as an international development, or really nobody took it that serious, because honestly, I wasn't hearing a lot of concern in December. I did see on CNN back then, and I also didn't take it that serious. I thought, oh, well, they must have eaten something again that they're not supposed to be eating. When I thought, hey, hopefully it doesn't come this side of the world, right? I didn't really think it would be something that serious. So let's see if they do make mention of it and how it could possibly affect them. Let's see. The information received since the FOMC met in October indicates that the labor market remains strong and that the economic activity has been rising at a moderate rate. Job gains have been solid on average in recent months, and the unemployment rate has remained low. Although household spending has been rising at a strong pace, business and fixed business investments and exports remain weak. Now, as you can see again, there is a change in the wording in relation to where is it? Household spending. Now, this is December. Remember I said October, November, December. Household spending naturally should rise. So it seems this was a good last quarter compared to which one? Which year? 2018. Let's move on.
Yes, I think this is a better one even compared to the one of June, because June they used the word soft, but now it's like it's rising again. I don't know if I'm correct.
Yeah, you're right, 100%. You're spot on, right? Okay. Although household spending has been rising at a strong pace, business, fixed investment, and exports remain weak. On a 12-month basis, overall inflation and inflation for items other than food and energy are running below 2%. Market-based measures of inflation and compensation remain low. Survey-based measures of longer-term inflation expectations are little changed. Consistent with the statutory mandate, the committee seeks to foster maximum employment and price stability. The committee decided to maintain the target range. You see, there's a change. The target range for the federal funds rate at 1.5% to 1.75. Don't know how really, but I know it's 1.75, 3/4, right? 1.5 to 1.75. So what happened? We saw the January one. Interest rates were here. Let me write it down. Interest rates in Jan range between 2.25% and 2.5%. We looked at the June report. Interest rate still were the same at 2.25% and 2.5%. Now, where are they? What happened there? This is December. This is December. We are now sitting at 1.5%. 1.5 and 1.75. Was that an increase or a decrease or a cut in interest rates? January, June unchanged, December 1.5 to 1.75. Interest rates, were they cut or were they?
They cut.
They were cut. Are we all on the same page, everybody?
Yeah. Jesus.
100%. Now, here they're not saying the committee decided to cut or lower the interest rates. They're saying the committee decided to maintain the target range for the federal funds rate at this. So that means they were cut at some point. They were not cut in December. So now your task has gotten even bigger. I should have just stopped at June. So that means your task, you need to go read the whole report from January to December to establish where did they cut, when did they cut those interest rates? Because they cut those interest rates, okay? And at the start of this report, we see that there is some sort of gain in terms of economic activity. See, they say it remains strong. The labor market remains strong, and the economic activity has been rising moderately. Earlier, there was something wrong with it. It was slowing. Now it's rising moderately. Why would it rise moderately? Of course, they did something. They lowered the interest rates. Remember, I said interest rates will act as a
rate. I got it.
You get it?
I see the picture. Yeah, when the interest rate low, economy grows, right?
Mm-hmm. You lower the interest rate, the economic wheel starts to turn again, right? The economic activity starts to rise. Employment starts to get stronger, right? People are being employed because, more money is in circulation. Yeah, man. I don't know if you can see that, right? The wheel starts to turn faster when you lower interest rates. The wheel starts to turn faster. Earlier, the wheel was slowing down. And the interest rates were 2.5. They did mention in June their concern. It was a genuine concern. They said, but we will monitor it. They didn't say, no, we are cutting interest. They said, no. They made mention of their concern, and they said, we're going to monitor it. Now, fast forward 6 months later, we've moved from June to December, and we can see at one point, they cut those interest rates. And there has been a change in the economic activity. Right? There has been a change. Any question? Right? So they say the committee will continue to monitor the implications of incoming information for the economic outlook, because remember they said that last time, the economic outlook remains uncertain. Right? Where am I? Economic outlook, including global developments and muted inflation pressures. So there's no concern about that. They're saying muted. If inflation was at too high, they wouldn't say it's muted. They're concerned that they're not quite where they want it to be. It's too low. Right? In determining the size, well, then they make no mention of what's going on in China. It's no concern. It's not mentioned at all. And this is December, and this thing is rife already. But there's no mention of it. But I promise you, if you read the first report of the year 2020, they will make mention of it. And you'll see how quickly the economy changes and the policy changes, right? Let's leave it here for today. Let me give you an opportunity. Let me not drag it on and on. Let's just leave it here. Go and read those reports, 2019. We'll go very swiftly through them as well. The ones that I think would be important, I'll go through them tomorrow, and we'll go into the next year, 2020, and the next year. So you can have context of what has been the theme for most developed economies for the last 4 years. What has been their concern? Are you following?
Yes, sir.
Yeah, okay. Yes.
So, hey, let me not just give you too much information and overload you. But yeah, when you do have the time, just, read over those. Whatever you don't understand, the beauty about you don't have to go through the encyclopedia, those 12 books. No, Google is your friend. Google is your friend, right? You can find those terminologies. They can be broken down very easily. And I'm also there to help, of course, right? I'm going to break them down for you. Ladies and gents, let's leave it here for today. I trust.
Before we go, Lebo.
Yes, sir.
We want to go to the chart to see money.
Now you're talking. What charts of charts? Yeah, I should have forgotten. Okay. Any particular charts
no, you mentioned
that
you
you're
entered a
interested
sell
in?
in Nasdaq.
Oh yes. Yes.
You entered a sell in
Let me
Nasdaq. So we need to know your thought process. How you ended up pressing a sell.
Yeah. Right. So remember last week I said month end. It's month end. And of course, anybody who has been holding on to those positions from July, August, no, is it July? July, August, September. Yes, July, August, September. That was an entire quarter, Q3. So anybody who has been buying, are we on Nasdaq? No, Nasdaq. Let's go to a daily chart, maybe. July. Why is it so funny? What's going on with this? Let's look at the weekly, if that will help. I've been trying to open my trading view, but it just won't allow me. Something's not right. But I think you get the idea anyway. From July to here, everybody's, somebody's been buying. It's been bullish. So every quarter, if somebody has been holding for that entire quarter, or even if you were not holding for the entire quarter, I think you can understand that it's been bullish, and a consolidation needs to happen. We need to, take profit, right? We need to take profit. We've had a bullish 3 quarters, or not quarters, 3 months. An entire quarter has been bullish. Some profit taking would need to happen, right? Some profit taking would need to happen. So at the end of the month, that's what we expect, right? If somebody's been holding that position for the entire month, take profit. If you've been holding that position for a week, usually at the end of the week, Thursday, Friday, you want to take profit. Usually Fridays, you want to take profit, right? For the month, the last few days of the month, you start to see that rotation, right? You start to see that rotation. So my trade decision was merely based on net fact, but also technical, the price action needed to dictate that entry for me. If you remember here, and I think it was this group. Let's go back. Hey, I don't like MetaTrader for this reason. But this here, I marked it out with you. Okay? We were looking at where can we enter? Right? We said if it closes above there, sure, role reversal will enter. But if it comes back down here, that's still an entry. This is basically where fair value is. This definitely did play. I forgot actually. I've been meaning to mention it. Does anybody remember this trade? Anybody? You're making me suspicious. Is it this?
I think it's not our class.
Let me check. Are you serious? Maybe it's the other one, ne?
The previous class, I think.
Recordings. Yeah, it could be. It could be. But yeah, sorry. Yeah, it could be. But I'll double check. That's a trade that was taken, right? Role reversal was supposed to take place here. Continue to push higher. Loss of momentum, go sideways, come back all the way back to the initial start. So I saw that, I figured, well, it's month end, like I said. Give me a sec. It is month end. And I was looking at this particular play here. This is no longer support, it is resistance. And we had lost that bullish momentum based on our moving averages. As you can see, we just quite flat. And it was on the hourly time frame. Or was it lower than that? Let me see something. I'll tell you. I think I was on the 15 minutes time frame. Yes, I was on the 15 minutes time frame. And all I did is my approach is always simple. Okay. See this? We still close below. We have a much prominent bearish candlestick. And I figured I'm going to go in. And that's what I did. Went in. My stop loss was above there. We went sideways for some time. It can make you, mentally fatigued and start to question, are you in the right trade? And then as you can see, it just went all the way down. Right, all the way down. Of course, this is support. I'm supposed to be out. So I'm going to be out of that trade actually. Need to be out of it.
Lebo?
Going to, yeah.
Why didn't you enter your sell on before this engulfing candle? I think there are two. If you go back a bit, I'll show you.
Back
which
into
looks exactly like that one. Yeah, here. You can, yeah, in the mid to go. Yeah, there's somewhere there. Yeah, that one. Okay. Why didn't you enter your sell there?
I wasn't present on the charts at that time, honestly. Because
it's exactly the same
sell, but I wasn't on the charts. Right? No, in fact, this is yeah, I wasn't on the charts. Why is the date so funny here? Because I didn't enter this trade today. This was on the 27th, but it looks rather very weird, man. No, man. Hold on.
Oh, you've been holding?
Yeah, I've been holding on to this since last week Friday. Last week Friday was the 27th. Yeah. Or was it the 26th? Can't remember. But I've been in that trade since last week Friday. This is something that looks weird here. It wasn't here. That trade wasn't entered here, no, man. I entered that trade. You see. All right, what I'll do is let me try and get my trading view up and running, because for every trade that I have that I execute, well, most anyway, I would have my analysis on trading view, which I can't open right now.
Sorry, sir, are you still going to hold this trade?
I beg your pardon?
Are you still going to hold the sell?
I don't think I'll hold it unless we violate, right? I don't think I should be out. Technically, I should be out of that trade. I'm supposed to be out of here.
Yes.
Right? Supposed to be out of that trade because Q3, I mean, Q4. We're in a new quarter. And this last quarter here tends to be very bullish. Right?
Yes.
And we've got the fundamentals to support that bullish move. We've just had interest rate cuts by 50 basis points out of the US. So it's all green for this. If anything, that correction is done. We've come in and tested a significant level, previously resistance. We should be pushing higher from this point. So bulls are here, right? And those who have missed it, then you want to. Yeah.
So is it the right moment to enter and buy?
I wouldn't say this is the right moment. You don't want to catch a moving train. Anything in between, you're not a bull, you're not a bear, as they say, you're a pig. So let's wait for something like this to happen. Either we're going to come back into the zone, revisit one more time. Maybe those, retail bulls will be squeezed out. Then you can catch it again, or you're going to catch it here. Okay, we can see this is a previous level of support where we've just been bouncing. So the close above there, I think is quite clear that we are definitely in bullish territory. It will be very clear that we are in bullish territory.
What's the reasoning behind these quarters label?
That one I don't want to touch yet, right? But it's not that technical actually. It's just historical data. I'll go over it tomorrow with you, right? Maybe, yeah. Maybe this inflation and interest rates. I'll skip it for tomorrow. I'll talk about seasonal trends and cyclical trends. Says I've lost my connection. Am I still there? Testing. Test 1 2 1 2. Testing.
Is this solar system? Maybe it's the network. The Which one do you guys use? MTN?
Testing. Am I back? I think I'm back. Testing.
Yes, yes, yes.
Sorry, the internet connection just decided to dip. I think maybe, just maybe, there's no power in the area. So
you need to.
how's the audio? Can you hear me?
You need to buy Starlink level.
Test. 1 2 1 2. Okay, let me run a test of myself. Testing.
We can hear you.
Yes, we can hear.
Okay. We got cut off there, and there was a question. I think
about quota. You keep on mentioning quota, and I think quota is 3 months.
Yeah.
What's happening in these quotas?
All right. So, like I was saying, maybe then what we'll do is just for tomorrow, I won't talk interest rates and inflation, or maybe I won't go as deep as I did today on those. We'll talk about these quarters. Let's break them down so you can understand them, right? Yeah. I like the question because I've been hinting them. I wanted to see if anybody's picking up that there's a significant quarters. So thank you. It took you guys 2 weeks to finally ask them. But yeah, better late than never, hey? So we'll definitely go through them. It's something that you're going to enjoy. It's not too technical. It's not too difficult, I must say. So we'll talk about those quarters and how the market tends to behave. Remember I said there is a rhythm to the markets, right? What happens today, tomorrow, next week, next month, next year, it's not entirely new. It has happened before. So all we have to do is learn the song, right? Okay, so as we wrap it up, on this NASDAQ, right? Like I said, the fundamental aspects are covered. We understand that it's conducive for, to be risk on. It's conducive for NASDAQ, Dow Jones to be bullish, right? We've got all the makings of that. Low interest rates, right? And we understand what low interest rates mean. It means a liquidity injection. There's more money in the economy, right? Well, that's, let me put it this way. Monetary policy, its effects are lagging. It takes a little while, but we are going to see that money supply increase over time, right? It doesn't happen instantaneously, right? But we know the effects of low interest rates means an increase in money supply. It's liquidity. And of course, stock markets love liquidity because smart money, they take that money and invest it in the stock market, right? They call it a risk-free trade to a certain degree, but we'll talk about it, right? So this, we know we're supposed to be buying. Those sells, we will play them for as long as they last, okay? Now, think about it. Somebody bought share, okay? Somebody sold here, right? Now, likely, for those who use Fibonacci, I'm sure this move from here to there could be if Fibonacci, golden Fibonacci ratio. It either turned at 50 or 61.8. 61.8. Do we all know Fibonacci?
Yeah, we know there's a tool called Fibonacci.
Yes.
But the application of it, that's where my end is lagging.
Okay. That too shall be covered tomorrow. But quickly, right? I'll show you the tool. Go ahead. Oh, I thought there was a question there. So on the Fibonacci tool or indicator, let me just do this. There's some feedback on somebody's line there. Right. Okay. There's what we call a golden ratio on the Fibonacci tool. Golden ratio. Now that golden ratio is 50. It's between 50 and 61.8. Right? Let me highlight that golden ratio. It's this here. See how the market sold off and then corrected and then sold off again. Exactly within this red zone. right? Your Fibonacci tool is a very simple tool to use. It's there to show you possible points of entry based on retracements. We'll talk about it tomorrow. That's exactly where it turned. So somebody who sold here may have entered another sell here, or those who missed it here may have used the tool and said, where could it likely likely turn? We can see it's buying. We're not convinced about the buy. We're thinking it's still going to sell. Then they use the tool and say, this is where I'm going to catch that sell. So they may have sold here, okay? Or they. Okay? Now somebody out there also is saying, I think we're still yet to see more sales, right? Remember, it's a game of probabilities. Nobody knows, right? Nobody knows. So, but there are bulls and bears. You have to choose a side. So for somebody who's a bear, for whatever reason, they might have reasons. Hopefully they have reasons for that. This was what? Support. We bounced off. We violated. Role reversal. What are they going to do here? They're going to sell.
They're going to sell, yes.
Hence, I said before we got cut off, if you're a bull, you want a clear close above, then you will be in bullish territory. Right?
Mm.
But sellers are still in control of this. Somebody saying, we violated. Label always says violation, retest, then we go. So there is the violation. There's the violation. You follow? So somebody is prepared to sell at this point. And they want to see that happen. Go into here, sell again. Fair enough. There's absolutely nothing wrong with it. It's a sound and logical plan, if I can put it that way. Fundamentally speaking, and if you look at the higher time frames, well, we know this thing is it's a series of higher highs. So there's, of course, those who are willing to buy, but we need to give each other a chance. We need to give each other a chance. So a clean break above this point, yeah, sure, definitely. Bulls seem to be coming back. And of course, above this point, I think it will be very obvious that bulls are definitely back. Above this point, yeah, definitely bulls are back. There's nothing confusing about that. How many more bulls do you want to see before you say, okay, we're buying? Do you want to see a new record high first? Well, some might say, yeah, and that's perfectly fine. As long as you follow a clear and sound thought of process. A clear and sound criteria for entry. Does that make sense? Violation, somebody wants to sell. They're here. You as a bull, and we have the facts. Wait for it. It needs to be clear. We want to see a clear violation. Let it push up, come back down, then we'll buy. We'll buy at that point. We'll close above this significant high. We'll buy again. Close above that, we'll buy again. That's how we play it. Right? So, yeah. And GBP USD simply also based on that quarterly move. Take profit. As you can see, this might be done too. So I need to be out of that one because that's a fantastic one. And I'm starting again another $2,000 account with you so that you can see by the end of our sessions or by the end of the curriculum where we'll end up. So I've decided to cash out on that one and let it get too big, and I've started a new one. So already I had a few losses at the start, and then yeah, this single trade, at least on GU, that has given me what, at least 50% on that one. Right? So of course, if you're a bull, this is where you should be buying. That's GU. If you're a bull, you're in bullish territory. You close below that, we're in bearish territory. Bulls are definitely present at this moment. Right? Bulls, 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 bulls. Somebody might say, okay, this could be simply role reversal. Yes, you're quite correct. Just as you see on NASDAQ. Same thing might happen. Up, 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 then continue down. But a clear violation above it, then definitely bullish territory. Because you've already missed it. Nice buy there. Any other chat or question, maybe? Let's wrap it up. Gold.
Yeah, I think, Lebo, unfortunately, we couldn't see your entry. Was what I've noted in this industry of forex. Your entry is everything, you know. So yeah, unfortunately, we couldn't see your entries. Where exactly you entered?
Yeah,
because I mean, your entry. I think you know the importance of entry. Where you press buy or sell. That's point. You know,
100%.
It determines everything.
100%. And what we'll do definitely Thursdays. I like them quite a lot. Technical Thursdays. Let's do proper analysis because that sets us up for the new week. Those entries can be found already on the Thursday, and then come already the new week when people are only waking up to the fact that, oh, this is this type of trade. We're already in it. We've been in it for a couple of days already, right? And if there's anything, of course, I see, it's just a pity that I did not share those NASDAQ one and GU with you. I think I shared it with others, man. I forgot to share it with you on this group. But normally, when there are trade plans that seem more favorable to me, I do share them, right? I do share them with you. So I'll share that. Whatever I pick up on, I'll share. But for now, on GU, the trade plan is quite simple, right? Bulls are here, bears are here. Somebody who's been selling for month end might want to enter more sales here, right? But we do understand that we want to be buying this one. So if you didn't catch the buys here, wait for it to close above. And I'll make adjustments, of course. If I see that violation, I'll be the first because I use price alerts and I use pending orders. For example, a price alert, yeah, you can use a price alert on this, but it's pointless on MetaTrader because if your PC is closed, then you're not gonna get that price alert, right? So I like what you call this trading view much better because I've got the app on the phone, I've got it on my tablet. These are things that I carry around with me everywhere. So when I get those price alerts, it's gonna ring on my phone. And I've got a very annoying price alert. So I'm forced to open my my phone or my tablet to check exactly what's going on. Right. So it lets me off. So I don't miss the trade, basically. Because you can't be held hostage by a chat and wait for hours and saying, is it going to pass? You're going to lose hair. Ask me. Right? You're going to lose hair. You're going to bolt very prematurely. So let's avoid that. Price alerts are there for that. So you can, move away from your PC, close it up, and go to sleep or whatever. Do other things. Right? But we have a plan for definitely GU and NASDAQ. We know we definitely want to buy those. Gold, yeah, sure. Same thing. We want to buy it. But it hasn't, it's just doing its own thing to a certain degree. Gold is doing its own thing to a certain degree, but mostly attributed to geopolitical events. But I don't want to go into that today, right? So I think any other question?
Yes, Lebon.
Yeah.
Or you can start, madam.
No, I say maybe you can give us those tips about price alerts, please.
Yeah, I wanted to talk about price alerts. Yeah.
Okay. Yeah. So as you saw
tomorrow, yeah.
Okay. So what I did on MetaTrader, you simply right click, right? And when you go to trading, you're gonna see alert. Right? So wherever you right click, that's where your alert is going to be. But of course, you can make adjustments to that alert as well once you've placed it, right? Now, like I said, on MetaTrader, it's quite pointless because it's only going to ring on that particular device. And we know we close up our PCs. Well, we should be anyway, and walk away from these things. Now, the best way to do it is to do it on TradingView, but my TradingView is not working. Don't know what's going on, so I'll show you what I mean when I say it's not working. It's just been doing the same thing for the last 2 hours. All right, so I think I need to go into my
I think I think I've been using this price alerts label on TradingView.
Yes.
I think they just need refinement. Where I wanted, because every minute, you know, when gold is, for example, is buying, it alerts me when it's selling, but I think it's on a short time basis. So my question was, is it possible to put these price alerts, for example, on a swing basis, like H4 or H1 basis, something like that?
I kind of get what you're saying, but now let me explain it this way, how I use my price alerts. So I'll go into the chart, right, and I'll do my analysis, but price is not where I want it to be yet. It hasn't reached my entry point, right, or it hasn't reached a price point where I would understand what it means to me. For example, that what you call this Nasdaq chart that we've just looked at and the GBP USD chart. We know that for bulls, it needs to surpass a particular price point. It's not there yet. It might not happen even overnight, maybe tomorrow. But we don't want to miss out on that opportunity when price actually violates a key level, which is going to say to us, now we should be paying more attention to this chart. This is bullish territory for us, right? So I use those price alerts mainly for that, right? And I use them merely so that I don't have a lot of pending orders, right? Because sometimes I honestly forget about these pending orders, and sometimes my pending have stop losses. So I don't want too many pending orders where also, you know, I don't have complete control of what's going on in my account. Because like I said, brokers can adjust those pending orders. They can, you know, adjust it however way they want it. So in most cases, my pending orders are set within, you know, maybe I'll set them at the start of the week. And if that doesn't work out or they don't get hit, I might make adjustments or completely delete them, right? At the end of the week. So for various reasons, right? So pending orders for me is just something that will help me, that will alert me to say, hey, price alerts, right? It's just something that's going to help me say, hey, we're at the price point that you looked at, right? So this could be the time for you to enter or start putting those pending orders, right? And then walk away again. So I'll do it practically, of course, with you tomorrow and show you how I use my pending orders. I guess my pending orders and price alerts. Let me just put it that way.
Yes.
Yeah. Right?
Okay. Thank you.
Alrighty. I think we can call it a day.
Yes.
Yeah, let's call it a day.
Thank you.
Thank you.
Shaya there, Shaya everywhere.
Shaya there, day. Yeah, no, you now know my no.
Thanks, Level. I appreciate it. Yeah.
Session, eh? I'll send the recording within 45 minutes time. It should be in the inbox. Thank you, ladies and gents. See you tomorrow, same time, same place.